Welcome to our channel. If you're new here, make sure to hit that subscribe button so you don't miss any future videos. In today's video, we're going to be talking more about banks. Which bank do you use? And why did you choose that one among others? Bank is a term people use broadly to refer to many different types of financial institutions. What you think of as your bank may be a bank and trust company, a savings bank, a savings and loan association, or other depository institution. What is a bank? Banks are privately owned institutions that, generally, accept deposits and make loans. Deposits are money people leave in an institution with the understanding that they can get it back at any time or at an agreed upon future time. A loan is money let out to a borrower to be generally paid back with interest. This action of taking deposits and making loans is called financial intermediation. A bank's business, however, does not end there. Most people and businesses pay their bills with bank checking accounts, placing banks at the center of our payments system. Banks are the major source of consumer loans, loans for cars, houses, education, as well as main lenders to businesses, especially small businesses. Banks are often described as our economy's engine, in part because of these functions, but also because of the major role banks play as instruments of the government's monetary policy. How banks create money. Banks can't lend out all the deposits they collect, or they wouldn't have funds to pay out to depositors. Therefore, they keep primary and secondary reserves. Primary reserves are cash, deposits due from other banks, and the reserves required by the Federal Reserve System. Secondary reserves are securities banks purchase, which may be sold to meet short-term cash needs. These securities are usually government bonds. Federal law sets requirements for the percentage of deposits a bank must keep on reserve, either at the local Federal Reserve Bank or in its own vault. Any money a bank has on hand after it meets its reserve requirement is its excess reserves. It's the excess reserves that create money. This is how it works. Using a theoretical 20% reserve requirement, you deposit $500 in your bank. Your bank keeps $100 of it to meet its reserve requirement, but lends $400 to Ms. Smith. She uses the money to buy a car. The car dealership deposits $400 in its account at their bank. Their bank keeps $80 of it on reserve, but can lend out the other $320 as its own excess reserves. When that money is lent out, it becomes a deposit in a third institution, and the cycle continues. Thus, in this example, your original $500 becomes $1,220 on deposit in 3 different institutions. This phenomenon is called the multiplier effect. The size of the multiplier depends on the amount of money banks must keep on reserve. The Federal Reserve can contract or expand the money supply by raising or lowering banks' reserve requirements. Banks themselves can contract the money supply by increasing their own reserves to guard against loan losses or to meet sudden cash demands. A sharp increase in bank reserves, for any reason, can create a credit crunch by reducing the amount of money a bank has to lend. How banks make money. While public policymakers have long recognized the importance of banking to economic development, banks are privately owned, for-profit institutions. Banks are generally owned by stockholders. The stockholder's stake in the bank forms most of its equity capital, a bank's ultimate buffer against losses. At the end of the year, a bank pays some or all of its profits to its shareholders in the form of dividends. The bank may retain some of its profits to add to its capital. Stockholders may also choose to reinvest their dividends in the bank. Banks earn money in 3 ways. They make money from what they call the spread, or the difference between the interest rate they pay for deposits and the interest rate they receive on the loans they make. They earn interest on the securities they hold. They earn fees for customer services, such as checking accounts, financial counseling, loan servicing, and the sales of other financial products, e.g., insurance and mutual funds. Banks earn an average of just over 1% of their assets, loans and securities, every year. This figure is commonly referred to as a bank's return on assets, or ROA. A short history. The first American banks appeared early in the 18th century, to provide currency to colonists who needed a means of exchange. Originally, banks only made loans and issued notes for money deposited. Checking accounts appeared in the mid-19th century, the first of many new bank products and services developed through the state banking system. Today banks offer credit cards, automatic teller machines, now accounts, individual retirement accounts, home equity loans, and a host of other financial services. In today's evolving financial services environment, many other financial institutions provide some traditional banking functions. Banks compete with credit unions, financing companies, investment banks, insurance companies, and many other financial services providers. While some claim that banks are becoming obsolete, banks still serve vital economic goals. They continue to evolve to meet the changing needs of their customers, as they have for the past 200 years. If banks did not exist, we would have to invent them. Banks and public policy. Our government's earliest leaders struggled over the shape of our banking system. They knew that banks have considerable financial power. Should this power be concentrated in a few institutions, they asked, or shared by many? Alexander Hamilton argued strongly for one central bank. That idea troubled Thomas Jefferson, who believed that local control was the only way to restrain banks from becoming financial monsters. We've tried both ways, and our current system seems to be a compromise. It allows for a multitude of banks, both large and small. Both the federal and state governments issue bank charters for public need and convenience, and regulate banks to ensure that they meet those needs. The Federal Reserve controls the money supply at a national level. The nation's individual banks facilitate the flow of money in their respective communities. Since banks hold government-issued charters and generally belong to the Federal Bank Insurance Fund, state and federal governments have considered banks as instruments of broad financial policy beyond money supply. Governments encourage or require different types of lending. For instance, they enforce non-discrimination policies by requiring equal opportunity lending. They promote economic development by requiring lending or investment in banks' local communities, and by deciding where to issue new bank charters. Using banks to accomplish economic policy goals requires a constant balancing of banks' needs against the needs of the community. Banks must be profitable to stay in business, and a failed bank doesn't meet anyone's needs. You've got $1,000 you don't need for, say, a year and want to earn income from the money until then. Or you want to buy a house and need to borrow $100,000 and pay it back over 30 years. It would be difficult, if not impossible, for someone acting alone to find either a potential borrower who needs exactly $1,000 for a year or a lender who can spare $100,000 for 30. That's where banks come in. Although banks do many things, their primary role is to take in funds called deposits from those with money, pool them, and lend them to those who need funds. Banks are intermediaries between depositors, who lend money to the bank, and borrowers, to whom the bank lends money. The amount banks pay for deposits and the income they receive on their loans are both called interest. Depositors can be individuals and households, financial and non-financial firms, or national and local governments. Borrowers are, well, the same. Deposits can be available on demand, a checking account, for example, or with some restrictions, such as savings and time deposits. Making loans. While at any given moment some depositors need their money, most do not. That enables banks to use shorter-term deposits to make longer-term loans. The process involves maturity transformation, converting short-term liabilities, deposits, to long-term assets, loans. Banks pay depositors less than they receive from borrowers, and that difference accounts for the bulk of banks' income in most countries. Banks can complement traditional deposits as a source of funding by directly borrowing in the money and capital markets. They can issue securities such as commercial paper or bonds, or they can temporarily lend securities they already own to other institutions for cash, a transaction often called a repurchase agreement, repo. Banks can also package the loans they have on their books into a security and sell this to the market, a process called liquidity transformation and securitization, to obtain funds they can relend. A bank's most important role may be matching up creditors and borrowers, but banks are also essential to the domestic and international payments system, and they create money. Not only do individuals, businesses, and governments need somewhere to deposit and borrow money, they need to move funds around, for example, from buyers to sellers or employers to employees or taxpayers to governments. Here too banks play a central role. They process payments, from the tiniest of personal checks to large-value electronic payments between banks. The payments system is a complex network of local, national, and international banks, and often involves government central banks and private clearing facilities that match up what banks owe each other. In many cases payments are processed nearly instantaneously. The payments system also includes credit and debit cards. A well-operating payments system is a prerequisite for an efficiently performing economy, and breakdowns in the payments system are likely to disrupt trade and, therefore, economic growth significantly. Creating money. Banks also create money. They do this because they must hold on reserve, and not lend out, some portion of their deposits either in cash or in securities that can be quickly converted to cash. The amount of those reserves depends both on the bank's assessment of its depositors' need for cash and on the requirements of bank regulators, typically the central bank, a government institution that is at the center of a country's monetary and banking system. Banks keep those required reserves on deposit with central banks, such as the U.S. Federal Reserve, the Bank of Japan, and the European Central Bank. Banks create money when they lend the rest of the money depositors give them. This money can be used to purchase goods and services and can find its way back into the banking system as a deposit in another bank, which then can lend a fraction of it. The process of relending can repeat itself a number of times in a phenomenon called the multiplier effect. The size of the multiplier, the amount of money created from an initial deposit, depends on the amount of money banks must keep on reserve. Banks also lend and recycle excess money within the financial system and create, distribute, and trade securities. Banks have several ways of making money besides pocketing the difference, or spread, between the interest they pay on deposits and borrowed money and the interest they collect from borrowers or securities they hold. They can earn money from income from securities they trade, and fees for customer services, such as checking accounts, financial and investment banking, loan servicing, and the origination, distribution, and sale of other financial products, such as insurance and mutual funds. Banks earn on average between 1 and 2% of their assets, loans and securities. This is commonly referred to as a bank's return on assets. Transmitting monetary policy. Banks also play a central role in the transmission of monetary policy, one of the government's most important tools for achieving economic growth without inflation. The central bank controls the money supply at the national level, while banks facilitate the flow of money in the markets within which they operate. At the national level, central banks can shrink or expand the money supply by raising or lowering banks' reserve requirements and by buying and selling securities on the open market with banks as key counterparties in the transactions. Banks can shrink the money supply by putting away more deposits as reserves at the central bank or by increasing their holdings of other forms of liquid assets, those that can be easily converted to cash with little impact on their price. A sharp increase in bank reserves or liquid assets for any reason can lead to a credit crunch by reducing the amount of money banks have to lend, which can lead to higher borrowing costs as customers pay more for scarcer bank funds. A credit crunch can hurt economic growth. Banks can fail, just like other firms. But their failure can have broader ramifications, hurting customers, other banks, the community, and the market as a whole. Customer deposits can be frozen, loan relationships can break down, and lines of credit that businesses draw on to make payrolls or pay suppliers may not be renewed. In addition, one bank failure can lead to other bank failures. Banks' vulnerabilities arise primarily from three sources. A high proportion of short-term funding such as checking accounts and repos to total deposits. Most deposits are used to finance longer-term loans, which are hard to convert into cash quickly. A low ratio of cash to assets, and a low ratio of capital, assets minus liabilities, to assets. Depositors and other creditors can demand payment on checking accounts and repos almost immediately. When a bank is perceived rightly or wrongly to have problems, customers, fearing that they could lose their deposits, may withdraw their funds so fast that the small portion of liquid assets a bank holds becomes quickly exhausted. During such a run on deposits, a bank may have to sell other longer-term and less liquid assets, often at a loss, to meet the withdrawal demands. If losses are sufficiently large, they may exceed the capital a bank maintains and drive it into insolvency. Essentially, banking is about confidence or trust, the belief that the bank has the money to honor its obligations. Any crack in that confidence can trigger a run and potentially a bank failure, even bringing down solvent institutions. Many countries insure deposits in case of bank failure, and the recent crisis showed that banks' greater use of market sources of funding has made them more vulnerable to runs driven by investor sentiment than to depositor runs. The need for regulation. Bank safety and soundness are a major public policy concern, and government policies have been designed to limit bank failures and the panic they can ignite. In most countries, banks need a charter to carry out banking activities and to be eligible for government backstop facilities such as emergency loans from the central bank and explicit guarantees to ensure bank deposits up to a certain amount. Banks are regulated by the laws of their home country and are typically subject to regular supervision. If banks are active abroad, they may also be regulated by the host country. Regulators have broad powers to intervene in troubled banks to minimize disruptions. Regulations are generally designed to limit banks' exposures to credit, market, and liquidity risks and to overall solvency risk. See protecting the whole in this issue of F&D. Banks are now required to hold more and higher quality equity, for example, in the form of retained earnings and paid-in capital to buffer losses than they were before the financial crisis. Large global banks must hold even more capital to account for the potential impact of their failure on the stability of the global financial system, also known as systemic risk. Regulations also stipulate minimum levels of liquid assets for banks and prescribe stable, longer-term funding sources. Regulators are reviewing the growing importance of institutions that provide bank-like functions but that are not regulated in the same fashion as banks, so-called shadow banks, and looking at options for regulating them. The recent financial crisis exposed the systemic importance of these institutions, which include finance companies, investment banks, and money market mutual funds. Leave a like and share this video and don't forget to subscribe. See you in the next one.